Hello friends, my name is Shanti Dugard. In this video, I am going to explain the concept of comparative statements, common size statements, and trend analysis, which are used for analyzing the financial statements. So, as you know, the techniques for analyzing the financial statements are comparative financial statements, common size statements, and trend analysis, which will be covered in this video. And the techniques of ratio analysis and cash flow statement I will be covering in two separate videos subsequently. So let's first understand the comparative statements, how it is prepared. The financial statements or figures of two or more years are placed side by side in columns to reflect the absolute change and the percentage change or deviation in the numbers from the previous year. So that's called the comparative statements. I will explain this in a moment with one example. So most commonly comparative statements which companies prepare are for comparative profit and loss account and comparative balance sheet. And how these comparative statements benefits to the investors or the companies. So they help in making the financial numbers more comparable and more understandable, because absolute numbers have no meaning unless you get to know the change or deviation with respect to the previous year, how much they have increased or decreased over the years. And the percentage will indicate what are the weak points and strong points of the firm. If the sales and profit numbers are growing, so that shows good points or strong points for the company. And if reserve surplus net worth is increasing in percentage terms and in absolute terms, that will also be good points. Whereas any negative numbers in percentage in sales, profit, reserve, surplus will show a weak point for the company. Whereas for liability side, if the percentage is reducing, that will show the strong point. And if expenses, cost of goods sold are increasing, then it will show a weak point. So like that, when you compare the percentage and absolute change, you can figure out how the company's business is going in which direction, which also helps in forecasting for future business planning. So now let's understand the method of preparation of comparative financial statements, how they are prepared. So to prepare the comparative financial statements, in the first and second column, we just put the comparative figures of current year and the corresponding figures of previous years. So these are actual numbers. Then in third and fourth column, we just take the difference. The third column, we take the difference of absolute difference, and the fourth column shows the percentage difference between the current year and the previous year's numbers for each line item of the financial statements. So when I just say each line items, whatever is the financial statements which we prepare for P&L and balance sheet. So for each of the line item, the percentage deviation as well as absolute change with respect to previous years is shown in column fourth and column third respectively. So in common size statement, what we do, we compare the vertical proportions of each line with respect to a common base number. So for example, each number of profit and loss account can be compared with sales numbers. So each line item of P&L, whether it is revenue or cost, can be shown as a percentage of sales. And similarly, each number in balance sheet, both assets and liabilities, can be shown as percentage of total assets. So this is only an example. The base could be any number. We can say as percentage of total assets, we can make percentage of net assets, whatever we take the base. So each number will be compared with that base. So this will reflect how the weightage of each number is changing with respect to such base number over a period of time. So when we prepare the common size statements over a number of years, it will indicate how the composition of each item of income and expenditure, or the asset and liabilities have been changing over a period of time with respect to a particular base number. So this will also reflect the if the composition change is on the healthier side or deteriorating side over the years. So for example, if I will explain in more details when I explain the example. So common size statements help compare two corporates in the same industry. It, however, it has only limited uses. Why it has limited uses? Because it does not show periodical change trend like which we saw in the comparative statement. So percentage increase or decrease over two periods or multiple periods is not shown. It only compare the vertical proportion of that number with respect to a base number. So another limitation of this analysis is that there are no established standard norms for each item. So you can't say ki that sales that uh, COGS or cost of goods sold should be certain percentage of sales number. There is no standard norms for that. Similarly, the current assets should be so much percentage of total assets. There is no standard norms for that. So that's why you can't figure out whether the company has performed better than the standard norms or worse than the standard norms. That's why it has some limited usage only. Whenever you want to see the percentage change with respect to the previous year or previous years, you cannot use this common size statement. Now let's understand both comparative statement analysis and common size analysis with a simple example. So here I have put on the left hand side a typical profit and loss account of XYZ Limited. So sales revenue, let's say current year is 500, previous year was 400. So the absolute change is 100 and the percentage change is 25% over 400. So that shows the fourth column shows percentage increase oblique decrease in current year versus previous years, and the third column is the absolute difference between the two numbers. So let's say cost of goods sold, it was 280 in the current year, previous year it was 180, so it has increased by 40, and in terms of percentage it has increased by 22%. So whereas sales have increased by 25%, COGS has increased by 22.2%. So that's a healthy sign. So as a result of which the gross profit has increased from 240 to 310 million dollar. So gross profit has increased by 29% or 70 million dollar compared to the previous year. So similarly, if you look at the net profit here, 90 was the net profit in previous year, 110 is the net profit in this current year. So absolute increase is 20 and percentage increase is 22.2%. So this is how we prepare the comparative analysis. Now let's understand the common size analysis. Common size analysis, we take, let's say we take total income as a base or we take sales revenue as a base. So here I have taken percentage of sales revenue as the base number for current year. So this is 100 and for previous year also this is 100. Other income was 30. So 30 with respect to 500 is 6%. So each and every number of P&L is compared or expressed as a percentage of the sales revenue. So here we can see the cost of goods sold is 44% of the sales revenue in current year, whereas it was 45% of the sales revenue in previous year. Similarly, the depreciation is 4% of the sales revenue. Previous year it was 2.5% of sales revenue. Earning before tax 160 divided by 500 is 32% of the sales revenue, whereas previous year 130 divided by 400 it was 32.5%. So like that it will show us how each number is changing as proportion of weight with respect to a particular base number. Now let's understand the balance sheet. Here on the left hand side, this is a typical balance sheet of XYZ Limited as an example. So in comparative analysis, what we just do, the change between current year and previous year. So for example, fixed assets, previous year was 450, current year is 500. So it has increased by 50, and in percentage terms, it has increased by 11%. Now if we take long total liabilities were 120 in previous year, which has increased to 150. So the increase is 130 and percentage increase is 25%. Reserves and surplus have increased marginally from 130 to 140, 138 to 140. So it shows increase of only 2, which is 1.4%. So while the fixed assets have increased by 11%, the increase in the reserves and surplus is only by 1.4%, and liabilities have increased more in percentage terms. So that's how we analyze the comparative statements analysis. In common size statement, we can consider fixed the net assets as a base. So every line item of the balance sheet is compared with the net assets. So net assets is here. This is 390 is the net assets for current year, and 358 is the net assets for the previous year. So each line item we compare with respect to this number. So this becomes 100. So this is 100% in both the scenario, and fixed assets is 128% of the net assets. Accumulated depreciation is 51% of the net assets in current year. The current assets is 43% of the net assets, whereas last year it was 41%. So the percentage of current assets as percentage of total net assets have increased by almost 2.3%. Reserves and surplus, or let's say take shareholders equity has reduced as percentage of the total net assets. It was 66.6% in previous year. Now it is only 61.5%. Now let's understand the third aspect of financial statement analysis, which is trend analysis. So in trend analysis, what we do, we take the base year number as 100. So, and then every year's numbers we express as an index to that base number. So whatever year is taken as 100, that percentage, that index is 100, and then rest of the years we calculate the index with respect to that number. So it will show how the figures have changed relative to that base number over a period of time. So the benefit of this analysis is that it will show the trend of all the financial statements numbers over a longer period of time, and we can draw some conclusions that by change in the each financial numbers of both P&L and balance sheet item, whether this change is on the positive direction or in the negative direction. I will show you with one example here. Before we come to the limitations, that this has some limitation. This is not very informative because unless you correlate or compare with some other relative variables. So for example, sometimes you compare the index with a irrelevant variable, then it has no meaning. So looking at the trend or ratios may be absurd or meaningless when unless you use also know the absolute figures. And third limitation is that selection of base year may be manipulative, or base year may not be a normal year. Suppose a COVID-19 year you take as a base, then all future years numbers or previous years numbers will look so great against that base number. So base year sometimes can be very, very manipulative and not a normal year. So when another limitation is when the base year figure are very small, as I said, current year COVID-19, then the all numbers index compared to that base year becomes uh, highly uh, highly questionable or not relevant, or will give misleading information to the investors. The one more limitation is that inflation period, when we are passing through the inflation, then the percentage change with respect to base year will appear very high unless we adjust the index with the inflation. However, despite these limitations, the trend analysis is important and can be used if the base year is selected prudently or a normal year. Then there should not be any inconsistency in accounting policy. So accounting policy have to be adopted consistently to use to make the trend analysis useful. Then analysis should be performed for only those items which are logically correlated to each other. If they are not logically correlated to each other, then there is no comparison useful. For example, when you compare the increase in current assets versus increase in current liabilities, they are logically correlated. Similarly, the increase in liability and increase in reserves and surplus or increase in net worth, that can be compared. But if you start comparing two variables which are totally not correlated to each other, that will not be a proper use of the trend analysis. And the last is that when you get the index, in case of inflationary period, you should adjust those numbers with the inflation numbers to make it more meaningful trend percentage. So I will explain the example of trend analysis. Here I have put 5 years number. This is n minus 4, this is n minus 3, n minus 2, n minus 1, and current year number is n. So last 5 years number of XYZ Limited is plotted here. This is the P&L account, and on this side n minus 4 we take as a base year, let's say. So n minus 4, all the numbers is 100 as index, and then we show 300, it has moved to 325. So n minus 3 number is 108.3 with respect to n minus 4 number. N minus 2 number is index is 116.7. So every number is compared with the base of n minus 4 for all the numbers. So like that, if we look at the gross profit from 100 it has increased to 163.2, whereas sales have increased from 100 to 166.7. Let's take the net profit. Net profit with respect to base of 100, it has increased by 13.4. So it has become 113.4 in current year. So 5 years trend it shows. Similarly, for a balance sheet also, we can do the same analysis here. This is the 5 years balance sheet. So n minus 4 is the base year here. So all the numbers are 100 here, index, and we see the trend here. But fixed assets is 142.9. The current assets is 193.2. So with respect to 100, this has increased by 93.2% over 5 years time. Fixed assets have increased by 42.9% with respect to base year. Similarly, current liabilities, let's say here, current liabilities has become 266.7 in index terms. Then total liabilities has increased by 2.414 times with respect to the base of 100. And reserves and surplus and share capital put together, net worth has increased by 27.7% with respect to n minus 4 year. So index has become 127.7. So this is how the trend analysis useful and shows change in numbers with respect to a particular base number. Thank you. I have created some more financial management and statistical concepts video, and you can use it. You can see them on my channel, or if you want to have a interactive session one to one, or in groups, you may contact me at my email ID duga.shanti68 at gmail.com. Thank you very much. Bye.